The market's going to crash, ladies and gentlemen, residential and commercial. In spite of what you've been hearing, that it's only affecting the commercial sector, residential will follow. So follow me here. One of our great entrepreneurial leaders in this country, which is Elon Musk, some people are sitting back going, he's not an entrepreneurial leader. Like him or hate him, he's leading the country right now in technology, aerospace, you name it. He has his hands in just about every sector out there. So respected or not respected by the masses, he still has a respected word in the entrepreneurial space and business space. Same thing with Trump and a lot of the Mark Cuban and a lot of these big entrepreneurs that have become billionaires. The Berkshire Hathaways, Charlie Munger, Warren Buffett, all of these guys have respected names in the industry. In fact, what I'm going to go over today even quotes a little bit of what Charlie Munger was talking about and gives affirmation to what Elon Musk is talking about. And so for those of you guys that are listening to this for your own investment direction, pay attention to what I'm talking about here, because there is definitely going to be more massive downturn than we've seen thus far. Okay. Now, typically and traditionally over the course of time, residential real estate takes approximately 2 years following commercial real estate to show its signs of distress. Now, whether it takes exactly 2 years is all arbitrage, right? There's certain factors that play into this. But in order for the commercial market sector to be strong, it relies on our banks to be strong. And because 80% of loans are given to single family mortgages, at some point in time, small regional and community banks that are funding all these small loans, they land up getting bottlenecked because of what's happening in the commercial sector above and beyond the residential sector. So when they get affected with their commercial sector, money becomes more expensive on the residential end. When it becomes more expensive on the residential end, less homes are being sold and traded, which is what we're going through now, which lands up putting the banks at a standstill, and their revenue starts to decrease. You know, banks rely on certain variables like bond rates, what the Federal Reserve is lending them money at, so what their basis and the cost of their basis of money, they bank on it being at a certain percentage rate. So just like mortgagees, people that have mortgages on assets like office, retail, multifamily, residential, we all expect a monthly payment at the end of every month that is conducive to what we've been paying normally. But what happens is people end up getting into loans that are less expensive on the front end, thinking that the market's going to continue at the rate that it's continued at forever. So if the market had been at 2.5%, 3%, they feel like, damn, I got some time, right? Like it ain't going to jump from 2.5% to 7%, which is what it did in 1 year. And so we just lived that. We just saw that. So who is expecting that interest rates were going to go up between 4 and 5% in 1 year? Well, the banks didn't foresee it coming either. So what happened is they were lending money at a lower rate. They thought that the bond rates were going to be stronger, and because typically when the market goes into distress and stocks are not good, the bond rates typically go up. It didn't happen the way it typically does. Now bond rates are, but money's so expensive. There's this part of banking that's in limbo right now, and so we believe that the same thing that happened in 2008 when Lehman Brothers collapsed and AGS and all these big companies collapsed. It isn't just typically a handful of 5 regional banks. Typically, it's like 200 regional banks. So the beginning of this is just on the forefront. And what happens is criteria for debt becomes a lot harder to obtain for the average home buyer. So people end up stuck in their homes because they can't resell, because the value that they have in their home, people can't afford paying that value with the interest rates of current mortgages today. Because take, for example, you have a single family home. Let's just go off the median home nationwide, which is $390,000. So if you take a loan, most people put a modest like 5% down. So let's take like $375,000. Okay. So the average mortgage, $375,000. And you multiply that times a 2.5% interest rate from just a couple years ago. So times 0.025, That's going to be $9,300 a year divided by 12. You're basically paying $780 a month in interest. So if it's amortized, your monthly payment is probably just over $1,000, $1,000 a month if it's amortized over 30 years. Now, let's take today's interest rates. You take the same thing, $375,000 loan, and you multiply that times 6.15%, okay? So times 0.0615, that's $23,000 a year. You divide, so more than double, ladies and gentlemen, divided by 12. The interest alone is $1,921 a month. So amortized over 30 years, you're probably paying about $1,300, another $2,300, another $300 to $500 a month towards your mortgage and towards your buy down. And you're probably somewhere right around $2,300 a month. So now that just doubled, more than doubled the actual monthly mortgage payment on a 30-year fixed loan on the same exact house, same exact asset. You're paying double. It's just that more is going back to the banks, okay? So what ends up happening is people can't sell because there's less people that can afford that exact same home. So somebody that can afford a $375,000 home now can only maybe get into a $250,000 home because of the spread of cost of money because of increased interest rates. And so what ends up happening is that the commercial market sector gets unstabilized. And right now, the two biggest variables for banks that they lent money on 5 years ago is office and shopping centers, commercial retail, okay? Shopping centers specifically. So you have office and commercial retail shopping centers that 5 years ago, they were still doing okay because money was cheap. They could be able to cash flow these assets because rent rates have dropped over the last decade. You know, I live this. I owned a bunch of Subway stores. In 2008, we had a bunch of retail that this was happening to us on that we needed to reposition. And it was our Subway stores that kept us alive. We were paying rent from our own stores to service the debt on these retail centers, along with some beauty salons and a few small nominal leases that we were able to get. And what ended up happening was we landed up buying 13 stores. We had 2 mall stores that were in large shopping centers, large regional malls. They were owned by General Growth Properties, another one that was owned by Simon's Properties. And what happened was our rents went from like $6,000 a month to like $10,000 a month, but retail started to die, so even our Christmas money dropped. So a store that was doing $500,000 in sales, and we were netting $140,000 out of that, landed up dropping 10% one year, then 11% the next year. Our rent payments continued going up, and we were sitting back between a profitability that dropped from like $150,000 in net profit down to like $60,000 in profit. We owned our stores, but if we wanted to sell it and somebody had to come in and bear a mortgage, they couldn't even afford the mortgage because the store wasn't making enough money. So we landed up shutting the store down. We sold off all of our stores with the exception of 2. Our mall stores, we shut them down. We exercised what was called a limited liability. This is what's happening. The reason I'm explaining my story is because this is what's happening on a mass basis nationwide. So we, thankfully enough, Subway corporate would require a limited liability in every one of their leases. And so when I was in Subway, I didn't know about limited liabilities. I learned it by being a franchisee in Subway, and because I only was as knowledgeable as the leases that we were sophisticated enough to put together. And I never gave tenants a limited liability where they could write me a check for a certain amount and they could buy out of their lease. I just figured, hey, if you're in your lease, you execute it. You know, and if you don't, you default, it goes on your credit, right? And that was my leverage on people. And then I landed up buying a retail center where there was an Albertsons in it. And when I bought it, the broker kept talking about this limited liability that Albertsons had. And I said, what was the limited liability from Albertsons? And he goes, look, I think we can get Sprouts where Albertsons is, and we can secure the lease for Sprouts before we allow Albertsons to execute their limited liability. So we went to Sprouts and we started executing a lease, and we were doing tenant improvements on the shopping center. We went down to Albertsons, and we knew they wanted out their lease. They had asked us, but we hadn't talked about their limited liability. And at that time, I was in between the exercising of limited liability between Albertsons and me exercising my limited liability on my Subway store with General Growth Properties. I landed up writing General Growth Properties a check for $40,000 to exit my lease, allowing me to legally get out of the lease, and I wrote off the full $40,000. We owned the store for 11 years, so we had made $150,000 net profit for 11 years, so we had netted well over $1 million. We had made about $1.4 million, $1.3 million in revenue, okay? So we made our money. The store cost us 400 grand. We had written it off to zero. Well, we hadn't written off to zero yet, but we were taking depreciation, so we were gonna have to recapture that gain. So by the time I was able to sell off the store for maybe $100,000 and then recapture that gain, I was gonna have tax liability. So I said, instead of tax liability, let's go in and let's pay off our limited liability. Let's get rid of the lease. Let's just get rid of the store. Now somebody else isn't stuck in that lease. And then I could just write off $400,000 that I paid for the store down to zero. And what that was worth to me was about $180,000 in tax savings. So I said, well, shit, let's just write that thing off to zero. That saves me $180,000 in tax liability. I take the tax write-off. I've already made over $1 million on the store. And let's just call it good. Let's dust our hands off and let's walk. I took all the equipment out. We buttoned up the store for General Growth Properties. And then I sold all the equipment off at auction. So I landed up making money on that. Now, here's what's happening in the retail sector. So we went into Albertsons and we told Albertsons, hey, let's talk about exercising your limited liability. Their limited liability was $800,000. So we buy this property for $3.5 million and we go in, we have capital expenses, we sell, we get Albertsons out of there for $800,000. They exercise their limited liability, they write us a check. At the same time, we're executing a lease with Sprouts with parameters. And the tenant improvements for Sprouts was just over $500,000. So guess where we got the tenant improvement money from? Was from Albertsons to do the tenant improvements for Sprouts. We exited them out, we used their money, and then we charged Sprouts back for the tenant improvements over the course of 10 years, and we landed up getting all that money back out, and we were able to execute that limited liability. Now, there's companies doing that, and there's just companies that are straight defaulting on these leases, and it's putting commercial real estate in financial distress. And so what's landing up happening right now is that we have all this office and retail that's going into financial distress, and we have the banks that are unstable. So now they're putting parameters on single family residential mortgages. And so what's going to land up happening is here. Let me quote this to you guys. This came from Elon Musk and Charlie Munger, and it says, we are stuck in this limbo until the job market crashes and existing people with houses are forced to default on their mortgages, sending the real estate market into the next death spiral. Okay? That's what's happening, ladies and gentlemen. Let me read that one more time. We are stuck in this limbo until the job market crashes. Okay, so the job market has to crash, ladies and gentlemen. The job market, as you guys know it, has been super strong all the way through the pandemic. You know, where we've shown less than a 3% unemployment rate. Now, once we start pushing closer to like 7% unemployment rate, this is where all shit hits the fan, and this is where the housing market's going to spiral down. And it's going to happen because corporations can't function the way they're functioning if commercial real estate goes into distress. If banking goes into distress, the same job market and the same opportunity, because money isn't as expendable, they don't have the bandwidth to lend to small business owners. What you have to understand is that 85% of employment comes from small business owners. So if small business owners employ 85% of the nation's employees and lending becomes tight for 85% of small business owners, think about what ends up happening. There's layoffs. Layoffs start happening, ladies and gentlemen. And when layoffs start happening and the job market becomes weak, temporarily, but it's going to become weak, then what lands up happening is the housing market starts to spiral because people can't afford homes. Okay, and so when this lands up happening, the bank's instability and everything lands up hitting, and all shit hits the fan is the easiest way to say it. So understand that right now is going to be the driving force to the residential real estate market. So you guys should be paying attention if you're a real estate investor to the housing market. So if you're a realtor, you're selling homes and you're relying on a certain number of closings right now, and the market has been semi-volatile, right? Like 2021 was gangbusters. First quarter of 2022, gangbusters. What happened in March, April of 2022 to the residential housing market and resale? It dropped, right? it dropped, it plateaued. Then we had a little spike and it stayed like that all the way through the summer and into the winter. But then in January, February, we had massive stimulus, right? So we had really good residential months. In January, it started to peak up again. February, it went really exponential for a short time in March. And then what happened in April and May? It's kind of planered out a little bit. Now we'll get a little spike now after Memorial Day and just after the 4th of July holidays because people are on vacation right now. And then as the Feds increase interest rates one, possibly two more times of about a quarter basis points, hopefully mortgage rates stabilize. Hopefully, right? Like hope that they stabilize. We don't know what mortgage rates are going to do, but the cost of money is going to go up at least one more time before the end of the year. Okay? Then we're going to start seeing the residential market start to plateau. And as commercial real estate starts getting affected and residential loans start becoming more restrictive and the job market starts to become more compromised, what's going to end up happening is residential real estate is slowly going to start spiraling. So if you're a residential real estate investor, pay attention because there's two things. One, you need to be careful how you're buying, what you're buying. Because if the cost of money, same thing I've been talking about in commercial real estate. You know, there's these 5/1 ARMs that are expiring. Money's becoming due on the commercial side. And so people can't refinance commercial assets. Same thing's going to happen in residential. People are going to be on 15-year fixed, 10-year fixed, 5-year fixed, these 5/1 ARMs, 10/1 ARMs. And then all of a sudden they're going to be having these fluctuating rate mortgages. Their loans are going to come due and they're not going to be able to remortgage their properties because they don't have the bandwidth, the affordability, and small business owners are capped on what they can pay employees because the job market is so bad they can't refinance them. Hence, foreclosures go up. Okay? So you're going to want to pay attention to this stuff because one, you don't want to be that person that gets pressed, leveraged, and over leveraged and you can't get out of it. So I'll tell you guys right now, if you're in a position where you can refinance and get a 30-year or even a 15-year fixed mortgage and you can still cash flow your properties, refinance right now, okay? If you can do a government-assisted loan like VA, FHA, HUD lending, any of that stuff, exercise it now while you can still get a fair market value rent to stabilize your asset. And then just hover through this, right? Just get through it. Pay and afford your assets, get through it, because in 2 years from now, the market might be completely different. A year from now, it might be completely different. But you got to be able to planer through all of this. And if you can't planer through it, you're going to land up affected long term, okay? Now, if you're a strategic investor and you're looking for opportunity, this is where opportunities come from. Because I've always said, where there's blood in the water, there's opportunity. And right now, there's going to be massive blood in the water. This is what's on the forefront. This is what's being projected by some of the greatest billionaires and investors in the world. When you have Charlie Munger and Warren Buffett talking about this, you should probably pay attention. When you have people like Elon Musk talking about this, you should probably pay attention. And so when the world's greatest entrepreneurs are talking about this, what should you and I do? Pay attention. And so know that it's coming and position yourself to start looking for financially distressed assets. Now, here's where people win the biggest, okay? Because the best deals don't come to market. Now, there's going to be a lot of residential stuff that comes to market because there's just a lot more residential assets than there is commercial assets. But the best deals on the commercial side don't even land up coming to market. By the time they go to market, they're the lower valued good deals, right? The deals that are not valued as well as some of the better deals that got traded internally. Same thing with residential. The best deals are not traded on the open market, they're traded internally. So relationships and your bandwidth for networking is super important. Being able to plug and go with multiple realtors, residential realtors, commercial realtors, wholesalers, people that are skip tracing, people that are going in and paying attention to tax auctions, people that are going out and they're paying attention to divorce registries and they're paying attention to estate sales, people that are going in and paying attention to the mortgage companies and late payments, delinquent payers and mortgagees that are delinquent 30, 60, 90 days, that they're watching the progress of this and they're watching the bandwidth where they can go in and execute buying distressed assets at compressed prices. Office, ladies and gentlemen, is going to be a huge opportunity for strategic repositioning at less than mortgage rates, not valued rates, mortgage rates, because the values that once sat 5 years ago, they don't exist anymore. Even in desirable asset classes like multifamily, the values are plummeting. When you take cap rates up and cap rates double because interest rates have went up, values go down. And when cap rates go up, values drop. And so a property that was once worth $20 million might only be worth $12 million. I just underwrote a deal in Texas this weekend that they have $18 million in debt. Rent rates are at about $1.25 a square foot. Pencil the math. You take an asset with over 200 plus doors, and if you just multiply that times $1.25 a square foot, and you do the math, the property with a 6% cap rate, if you have a 6% mortgage on it, in today's world is only worth someplace in the neighborhood of about $13 million. Here's the problem. There's about $5 million of renovations and capital expenses that need to be done to even get the rent rates up to market value to get that. So by the time you subtract that $5 million in capital expenses, the property's only worth $8 million in the open market. Here's what's scary. An investor's going to get excited. They're going to go in and maybe sell this asset off for $15 million. And this person's going to be upside down from the day they buy it because they can't renovate it well enough to get market value rents and fill the asset because it's only 31% occupied right now. So they can't lease it. So in order to lease it with comps, they got to stump anywhere maybe modestly $3 million into it. Now now they're back at the $18 million mark. Even at $3 million. So I told him, I said, I can't pay more than $8 million for this building that you guys owe $18 million on. They go, can't happen. The bank ain't gonna approve it. I'm like, sorry, so sad, I'm out then, you know? But at some point in time, the banks have to be able to go in and cope with reality. And this, on the open market with banks, is what they're faced with. Is that themselves are gonna live in denial, try to leverage people. Once people can't get the loans and financial institutions aren't willing to lend on it and people start becoming financially compromised because of it, all of this will go to open market, and the banks already know that they have devalued assets on their books that they're going to have to account for somewhere, someplace. That's where you and I strategically come in, underwrite these deals to a T, and it's important that you understand how to underwrite them. At the end of this video, I'm going to put a link to a video that teaches you guys how to underwrite cap rates and net operating income so you can underwrite commercial real estate. Watch that video. If you like the content, ladies and gentlemen, on this video or any of our other videos, then click and subscribe to our YouTube channel and pound that thumbs up button. If you're rewatching this video, then put a comment, hashtag repeat, and let us know that you're watching this on repeat. But don't forget to give us some love. Give us a thumbs up. And even if you're a hater and you hate the content, give us a thumbs down. Let us know what you hate about it so we can fix it for you. But ladies and gentlemen, you have to position yourself today to take advantage of exactly what I'm talking about in this video. If you missed the beginning of this video, go back, rewatch it from the beginning so you have a better understanding of how we got to the conclusion of these properties here at the end. Ladies and gentlemen, go out and make it a great day. Compound your success. God bless you. And we'll see you next week on Wednesdays, Real Talk on Real Estate.